Good evening, everybody. I'm going to be talking about insurance options for cow-calf producers. So first of all, I'm Jenny Ifft. I'm an associate professor at K-State Ag Econ. I'm also our extension specialist in agricultural policy. There are a lot of insurance options available for cow-calf producers. And I think both cases, for the previous topics, if you have a good idea of your costs, if you have a marketing plan, it's going to be much easier for you to take advantage of these insurance options. So I'm really building off of Robin and Lavelle's presentations here. So insurance generally covers different kinds of risks. So it helps you plan for things that you don't completely control. You can get the production risk, something like the recent wildfires that happened, where you could have a lot of mortality that you don't always have control over. There's also feed risk. So you could have a drought and that's gonna affect your forage availability. Let's say you overcome any production risk and feed risk, you could still see your prices drop right before you take your calves to your sell barn, even to the point where it could wipe out your profits. So there's a lot of different kinds of risk out there that insurance can potentially be useful for. And the type of insurance I'm talking about is products that are available through the federal crop insurance program. So if you are a row crop producer, this is probably something you're pretty used to. Nearly all row crop producers use crop insurance. It might even be something you don't think about much anymore. It's pretty routine. You buy insurance from an insurance agent or a private company. That's why we call it a private-public partnership. However, the federal government does pay for a large cost of your insurance premium. So it is designed to be favorable to the producer. And there are a lot of options for livestock producers. Some of them are relatively new. Others have been around for a while and have recently become more favorable for the producer, which is why we're talking about them here. So why do you formally insure? First of all, lenders tend to like insurance. It can help you get access to a loan and make sure that you're able to repay. Vulnerability to drought is another reason. What are the implications for your operation or even your family? If you want to expand your herd, how are you going to be able to do that through a drought or some other type of disaster? Also, and I'll repeat again, a lot of the federal insurance options for livestock producers have become more favorable in the past few years. So maybe you thought about it 10 years ago and it didn't work, but things have changed in recent years. There are a lot of insurance options. I have a link here that goes through some of those, but I'm going to be talking about two here. These are products that are used across Kansas by a lot of producers, but still a relatively small share of producers. They're both increasing over time. One is pasture range land and forage, PRF, that can protect an operation against forage risk. And then there's livestock risk protection, which protects against price risk. It's very similar to an option. And we'll talk about both of these in depth. Now, the goal here is to talk about the basics of each policy. As with any insurance product, there's a lot of details. I want to give you enough information so you can think about whether or not these policies would be useful for your operation and decide if you want to learn more. And I'm also going to point out several areas for further study, things that you're going to need to think about yourself or sit down with an insurance agent to talk about. So first of all, if I had to write a tweet about what PRF is, I would say if you have pasture or hay and it's drier than usual in your area, you get paid. And so if you remember one thing, that's what you need to know. We're going to break down each part of this. So first of all, you have to have pasture or hay. So perennial hay crops or grazing. It works for both. There's also a policy called annual forage that we won't be covering for the sake of time, but it's very similar to PRF. It's just for annual forage. Second of all, it has to be drier than usual for this product to pay out of it to work. What I mean by drier is less precipitation. So that could either be rainfall or snow. So a lot of times when you hear about PRF, you think about drought or rainfall. And yes, that applies, but technically it's measuring precipitation. So you could get a payout for PRF from less snow than usual. The next part is PRF pays out based on what happens in your area. More specifically, it pays out for what happens in your grid. Grid is sort of the jargon. It's some of the language with the insurance product. And I have a map right here of our grid in Manhattan, Kansas. A grid is about 12 by 17 miles. You could think of it as about, I don't know, 10 or 15 Manhattans or one Fort Riley in terms of the area. It's really easy to go online to the USDA website. We'll give that link later and find out where your grid is. It's something an agent could also work on you with. But understanding what's rainfall like on your operation versus the grid is a really important consideration when you use this product, and something a producer needs to think carefully about. Next, this policy applies when precipitation is less than usual. So it doesn't matter whether you get 2 inches or 10 inches. It matters if the amount you get is less than usual. So we don't talk in inches here. We talk in terms of an index. Specifically, I'm going to talk about indexes that are scaled to 100. So 100, you can think of it like 100%. This is a historic average precipitation within a 2-month period or a 2-month interval. And we'll get into the definition of interval in a little bit. But again, we're not thinking in inches anymore. We're thinking on what precipitation was like relative to what's normal from a historic perspective. So one way to think about this, if you have an index of 75, that means rainfall during this time period is 75% of the historic average. Right here, I have the actual grid index for a grid in Riley County, Kansas. The link to get to that information is right there. But if you could really focus on 2011, we're going to go across that row. And this shows the precipitation index within each 2-month period. And you can see this varies throughout the year. So it was dry in January and February. You get into March, April, it was fairly average or a little bit wetter than usual. So over 100 means conditions are wetter than usual. Gets dry again in the summer. July, August is above average. And then it's been dry this fall and winter again. So precipitation levels can vary throughout the year. And again, you can actually go onto the USDA website and see this for 20 years. So there's a lot of information to understand rainfall precipitation patterns in your grid or in your area. So interval selection. So what month you want to use PRF is a really important part of this decision for a producer. And it gets a little complicated, but the important part is a producer gets to pick what months they use PRF. So you decide, and it has to cover a minimum of 4 months. So that's specifically that 4 months, you have to cover at least 2-month intervals. So you have to select at least 2 intervals are 2 months long. And then you have to apply weights to those that sum up to 100. I'll give an example of this later and on the next slide. And you can't have too high or too low of a weight for each interval. Why do you do this? This determines the relative weight of your protection with it, which in an interval. So higher weights, you pay more premium and your potential indemnity is much higher. So you get to decide what intervals are the most important. So in terms of examples, you may want to cover spring and summer months. So here, the first example, you're doing 50% in March and April, 40% in May and June, 10% in July and August. You could also cover winter months. So this one, I have 60% in January and February, 40% in November and December. Or you can cover all intervals throughout the year at roughly equivalent weights in example 3. So there's different approaches to doing that. Primarily, you're going to be looking at what months forage production is the most important. Some producers may also look at rainfall patterns and historic likelihood of indemnities. So it's something, again, this is something you have to sit through your agent and work through. Now, for the good part, when do you get paid? And not necessarily the good part, because that means there was a drought. But it can make a drought less difficult on an operation. So first of all, you get paid automatically. So precipitation levels are being measured and calculated by RMA. And if a payment gets triggered, you're going to get paid automatically a few months afterwards. And when you get paid is when your actual precipitation within a specific interval is less than the coverage level you select. So a major decision for this policy is what coverage level you use. That can be from 70 to 90%. If you buy a higher coverage level, it's going to cost more, potentially quite a bit more, but it also pays out more. For lower coverage levels, it's vice versa. I'll get through some specific examples of those ranges. But again, some examples on how that works. So the first row, let's say you pick a coverage level of 90% for your policy. And then in the March and April interval, your actual precipitation is 85. So actual precipitation is less than your coverage level. You get an indemnity. What if you look at row 2? What if you selected 80% and your actual precipitation index is 85? Your coverage level is lower. You don't get an indemnity. In the last example, row 3, you pick the highest possible coverage level, 90%. Your actual precipitation index is 120. So that's when it's wetter than normal. There's no indemnity at any coverage level when it's wet. And if that's a risk, then that's a type of risk that's not covered. That's not a situation where anyone's getting payouts. So how much do you get paid? That's going to be based on an estimate of the underlying value or returns from raising a hay crop or grazing. So if you think about the crop budgets that we put out here at K-State, estimated returns for alfalfa this year are about $200 an acre. So that's the kind of number that's being used to estimate this. And what it specifically is USDA Account calculates the county average values or county average returns. And then the producer has an option to some degree to make this a little bit higher or a little bit lower. So specifically, USDA estimates something called a county base value. These are different for grazing or hay. Hay is higher, grazing is lower. And then the producer can select a productivity factor. So 60 to, basically you can scale it down or scale it up from 60 to 150%. The intuition here is that returns might vary by producer, by soil quality. You have different types of land. Not all pasture or hay production is going to be uniform. The producer may also want to use this to lower their coverage or lower their costs. So quick summary of how indemnities are calculated. So first of all, what's the difference between actual precipitation and coverage level is actual precipitation less than the coverage level. Then you have your county base value, your productivity factor, then your interval weight, and that's going to be used to calculate your indemnity. So there are a lot of things here that the producer controls: the coverage level, productivity factor, and the interval weight. And there's some things like actual precipitation of the county values that you don't control. So a lot of decisions a producer has to make that can affect payouts. So quick example, I have a couple different intervals here for PRF policy for hay production in Riley County. And in the second column, we have weight, percent of value. So I've made the earlier months have a higher weight. July to August only has a weight of 10%. They add up to 100. The premium is higher in the earlier months, largely because of that higher weight. There's also higher protection. That's the value of the policy during those early months because of the higher weight. The actual index, that was the actual rainfall index or precipitation index during those months. So the March to April intervals and the July to August intervals were relatively wet. So there was no indemnity during those periods. But in May and June, your actual index was 78.7. And that's lower than the coverage level of 90% for this policy. So there's an indemnity of $12. So PRF is used almost everywhere in Kansas, higher in the Flint Hills in western Kansas, over 2 million acres, which is a relatively small share of pasture or grazing land in Kansas, but it's gone up quite a bit in recent years. So a lot of producers are seeing that this is a fit for their operation. The deadline's typically November 15th. It was moved up to December 1st. Generally, this is a decision you're going to need to make in late fall. So to summarize, PRF is going to protect an operation against generally dry conditions. This is a part of the federal crop insurance program. The government pays part of the premium. So if producers use PRF consistently for a long time, they should come out ahead. What I mean by that is a typical experience is that a producer receives more in indemnities than they pay in premiums. There's no guarantee of this, but it is the typical experience. In terms of management considerations, cost is a big one, and it can range whether you do hay or grazing, what coverage levels you select. I mean, the range can go from $1 to $20 an acre. And that's going to correspond to the protection it provides. And you can use it for catastrophic protection, or you could use it very actively to manage this risk. The risk reduction is another important factor. So some of this is how large is the guarantee and how much of a difference would this make for your family or your operation? But also, is the precipitation in your grid going to protect the risk you face on your farm? That's an important consideration. Some producers may also look at returns or the likelihood or frequency of indemnities. Great tools on the USDA website, and a lot of agents have tools for that as well. In terms of the important considerations, something that you need to spend some time on, either on your own or with an agent, what grid you select. There is flexibility. A lot of people have land that will overlap a grid, then you have flexibility on what grid you use. The grid versus farm experience is super important. What intervals you select, coverage levels, productivity factors. So there are some things you need to work through. Typically, the time investment is going to be the highest up front when you start using this policy. It could potentially become a routine decision over time. So how are we doing on time? Okay, so all right, we're on track. So next we're going to talk about livestock risk protection. This is a crop insurance product, livestock insurance product that works very similar to a put option, which Lavelle talked about. Again, if I had to write a tweet, if there's one thing you need to remember, what is LRP? If you have livestock and market prices are less than expected, you get paid. This is a pure price product. So it is relatively simple compared to a lot of insurance products. First of all, you do have to have livestock. So this could be feeder cattle. There's several categories there. I'm not gonna read those. You can also use it for fed cattle, different categories there as well. So these different categories, they don't affect whether or not you get paid out. They affect the value of your policy. So it's just a sort of a routine choice. It's also available for swine in Kansas, and there's growing interest there due to concerns about price risk and African swine fever. But this presentation is going to focus on feeder cattle. So for market prices, what we mean by that, for feeder cattle, it's futures. For fed cattle, it's USDA AMS prices. Feeder cattle are going to be the focus of this presentation. We're focused on cow-calf risk management. So I'll be talking about futures prices a lot. So what do you mean by less than expected? The question here is the actual price less than what you expected. By expected, that's the futures price at your intended marketing date. And the actual price is what the price actually ends up being. Another terminology with this product is the endorsement length, and that's the time between when you buy a policy or an endorsement, when expected price is established and when you intend to sell, or the end of the coverage period, when actual price is measured. So say you calve in March and you plan to sell weaned calves in September. So the expected price is September futures value in March if you're buying a policy in March. The actual price is going to be the CME price in September. The endorsement length here is about 26 weeks. Now, important point with this policy, this also applies to any type of hedging. LRP is not based on local cash prices. So if your local price, your sell barn or wherever you sell is pretty closely linked to futures price, that's not a huge concern. But if it can be pretty different and not follow those trends, that is something to think about with this policy. So when do you get paid? Again, if it's the expected price or coverage price is less than the actual price. So with LRP, like a lot of other policies, you select a coverage level. With LRP, it's from 70 to 100%. And that coverage level times your futures or expected price is going to give you a coverage price. Like with a lot of insurance, you get what you pay for. The higher coverage levels cost more, but they do pay out a lot more. Lower coverage levels cost less, but they pay out less. So let's do a quick example. What are the payment triggers? Again, we're assuming March calving, you sell in September at wean. And for simplicity, let's say in March, September futures are $200, a little bit more than where they are currently. So this means your expected price is $200. Look at the first row, you select an LRP coverage level of 95%. That gives you a coverage price of $190 per hundredweight. Your actual price is $180. That's less than your coverage price. You get an indemnity. Second row, you select the coverage level 85%. That gives you a coverage price of $170. Your actual price is $180. Your actual price is higher than your coverage price. You don't get an indemnity. The third row, 85%. Your coverage price is $170, but prices go up to $230 a hundredweight. There's no indemnity for this at any coverage level, but the good news is prices went up. And so this is where I want to make a reminder that this is insurance. When insurance isn't triggered, that means prices were at the expected level or they were even higher than expected. So you still benefit from high prices with this policy. So LRP is not as widely used as PRF right now, but it is used in several counties throughout Kansas, and participation went up a lot in 2020 and 21. A big part of this is that the federal government share of the premium has increased, so it's more affordable now. And you also tend to see more people using this product when prices are high. Look at 2014, 15, when prices were strong, a lot more people were using it then as well. So you can sign up for LRP anytime. This is sort of like registering. You're not buying a policy, but it makes you eligible to buy a policy. The technical term is an endorsement. So when you want to have LRP, you go to your crop insurance agent and you purchase an individual endorsement. Now, the costs of LRP are based on futures markets, so they can vary day to day. And they're available based on your expected sales date and different lengths of policies or endorsements. So there can be a lot of fluctuation here. And the period when you can purchase LRP is between 3:30 p.m. and 9 a.m. So whenever I talk about insurance, I like to emphasize the relationship with your agent is important. So here you need somebody that you can call at 4:30 in the afternoon, 5 in the afternoon, or early morning, and they can help you put this in. Another important part of this is because these prices can fluctuate on a daily basis. A producer needs to have an idea of what's an acceptable cost, a premium cost, or what an acceptable market price is, and the timing of that beforehand. So knowing your cost of production, having a marketing plan can make LRP relatively straightforward to use. I'd also say that if you're thinking you want to try a marketing plan and hedging is kind of intimidating, LRP might be a good way to start doing that. There's no participation minimum with LRP, and it is typically more affordable than a put. So why would you use this? You could talk about black swans or risks in the market. Lavelle talked about what's happening in Russia right now. That's the big one. So I probably should have replaced China with Russia, but there's a lot of things that can happen. So it's a way to protect your operation against declining prices or to take advantage of relatively or absolutely high futures prices. Also, it's a way that could improve your relationship with a lender. Federal government pays up to half of the premium. So compared to hedging, it's going to be a little bit lower cost than a put, no margin account or margin calls if you're using futures, or no head minimum as well. Now, some producers will want to use the futures markets because of flexibility or other reasons. It's not to say this is not an absolute comparison, but there may be some advantages for hedging for some producers, especially smaller producers that are concerned about that minimum. Other important details: there is a maximum for cattle, probably not going to affect most cow-calf producers. You have to use it in the state where your cattle are located. This third point is pretty important. So you can't sell your animals more than 60 days before the end of the coverage period without approval. So you have to keep them about 2 months before you plan to sell, before the end of your coverage period. This may be an issue in terms of flexibility. However, you're actually not required to sell them at the end of your coverage period. You just can't sell them too early. So that's an important consideration with this product. A recent change is you can purchase endorsements for unborn feeders. So say you're calving in April, you're going to plan to sell in October. You could buy an LRP endorsement for that right now. The animals don't have to be born. So quick example of the cost. I did use actual prices, but these were from a few days ago, so they're slightly outdated. Futures prices were a little higher than 196 per hundredweight. So at that futures price, you can get a different range of coverage prices from 195 down to 176. That's the first column. Second column, it's coverage levels. So from 99 to 89.5%. The total premium is the actual cost of this policy. So the actual cost, $2 to $9, wide range, but what the producer pays goes from about as high as $5.81 for the $195 policy, all the way down to about $1.50 for the policy that's 89.5% coverage level. So quite a wide range of prices and costs for this policy. It's an important part of the LRP decision. What about payouts? So we're looking at the same policy. Suppose you choose the highest possible coverage price or highest possible coverage level, about $195 per hundredweight. The producer premium for this, it's $581. What happens when your actual price, 160? So that's a more catastrophic event. That's a large drop in expected prices. Your indemnity in that case would be $35 per hundredweight. Payouts like this are pretty rare. This is relatively close to what happened in 2015. What's more typical would be a decline in prices to 180 or 190. That's that second column. Corresponding indemnity there, $5 to $15 per hundredweight. That last column, if actual prices go up to $200, you don't get any indemnity, but you do have those higher prices. What about low coverage? So here we look at a coverage price of about $176. That's about 89.5% coverage level. Producer premium here, it's about $1.50 per hundredweight. That's that third column. So I have hypothetical actual prices in the second column. So that 160 per hundredweight, in this type of situation, that's a large drop in expected prices, so fairly catastrophic. In that case, you get about $16 per hundredweight. But for more typical price declines, say about to 180 or 190, there's no payout there. So it's an example of what potential payouts could look like under this policy. So to wrap up, LRP, the government share is higher than it used to be. It's up to 50% of the total premium cost. So if this is something you looked at in the future and it seemed too expensive, it might look a little bit different now. Again, it's more small producer friendly. There's no minimum on the head of cattle that you can enroll. It should be lower cost than a put. Those high coverage policies, they do provide the highest protection and return over time with relatively frequent indemnities, but you could be paying over $5 per hundredweight for feeders. So that's, with that kind of cost, you probably have helpful to have an idea of your break-even costs and how that fits in. Maybe even looking at relative to other input costs. The lower coverage policies provide catastrophic coverage. They're going to occasionally pay out indemnities, help you out when there's a large drop in futures markets with a much lower cost. So went through those policies pretty quickly. I'm happy to ask more, answer questions either now, or you can contact me individually. A lot of resources on the subsequent slides as well. If you know a livestock agent, they can also be helpful in figuring these out. So.
All right. We're gonna have all three of us slide in here and take a couple questions before we sign off for the night. Looks like you get the first one, from Sandra.
Okay. Can PR, so if you wanted to do something like triticale or oats, if you were growing it as forage, you could buy an annual forage policy. And it's very similar to PRF. It's a rainfall index. It's fairly easy to use. It's not used as much as PRF, but it is, a lot of agents sell it all over Kansas. So definitely an option. It's just not called PRF. Yeah. Okay. Next question. Yes, PRF can be used on rented pasture. Definitely. You can't double dip though. So usually when you buy a policy, you can do the insured share. So you could split that policy with your landlord straight up. It could be for all the producer. You could have an arrangement for sharing indemnities with a landlord. A lot of flexibility there, but you can definitely use it on rented pasture. So wait, can both renters? That's an interesting. That's a very specific question. That's a good one. I would say anything I say with if you have sublease through a custom grazing enterprise, it's probably a question to ask an insurance agent. As long as both renters, if the renters could probably split it, but you can't have the same policy for 100% share on one piece of land.